In this video, I want to talk about how to analyze the performance of real estate investment trust. How do you analyze or access or evaluate the performance of a typical real estate investment trust? So what key metrics do you consider in this analysis? That's the essence of this video. Number one is understand the real estate investment trust. Understand the type of the REITs you are considering. There is equity real estate trust and there is mortgage real estate trust. So let's talk about some equity real estate investment trust. So this particular one, focuses on owning and managing physical properties. So you analyze the type of properties they owned. It could be residential, it could be commercial, it might be industrial. And you also take into consideration the geographical distribution of those assets. So you analyze the physical structure they own, and you take into consideration the geographical location of those assets. That's for equity real estate investment trust. As for mortgage and real estate investment trust, you focus on the real estate debts, such as mortgages and mortgage-backed securities. You look at their loan portfolio, the interest rates, as well as the credit risk. So this is how you analyze a typical mortgage real estate investment trust. Number two is you evaluate key financial metrics. Evaluate key financial metrics. This will involve funds from operation, net asset value, dividend yield, payout ratio, as well as some debt to equity ratio. So let's start with funds from operation. So fund from operation is the most important metric for evaluating real estate investment trust. It adjusts net income by excluding depreciation and gains or loss on gains or losses from property sales, providing a clearer view of operational performance. And so a growing fund from operation indicates a healthy real estate investment trust. The second one is net asset value. The net asset value represents the real estate investment trust total assets minus total liabilities, reflecting the value of the real asset holding. So a REIT trading below net asset value could be undervalued, while one trading above might be considered overpriced. The next item is dividend yield. So REITs are known for high dividend payouts compared to, you now compare the REIT dividend yield with peers in the same sector, with other company in the same sector. So a high yield may be attractive, but it could signal potential risk if it is usually high compared to industry norm. We expect high yield anyway, but if it's higher than what is obtainable in the overall industry, it might portend risk. It might be indicating that the investment is risky. You also look at payout ratio. This ratio shows that it shows what proportion of REITs earning is paid out as dividends. A payout ratio close to 90% is typical, as REITs are required by law to distribute a large percentage of their taxable income to their investors. And so a very high ratio could indicate, sustainability concern. Although they are expected to pay out 90% to their investor, 90% and above. But in a case where the ratio is very, very high, it could indicate that the company concerned might have an underlying problem that needs to be looked into. The next item is debt to equity ratio. Debt to equity ratio. So real estate investment trust, often use leverage to finance property acquisition. They borrow money to finance or to buy property. So a high debt to equity ratio could signal increased risk, especially in a rising interest rate environment. That means they're going to pay so much as interest on the amount they borrowed. So we aim for a balanced ratio that reflects prudent borrowing. So go for a company that has a lower debt to equity ratio. Number 3 is assess property portfolio quality. You assess the property, portfolio quality. In this case, you consider portfolio location, you take into consideration tenants quality and lease terms, as well as some occupancy rates. Let's start with property location. Properties in prime locations or growing markets tends to generate more consistent rental income. Research the geographic areas where the REITs operates. Number 2 is tenants quality and lease term. Check the quality of tenants and the length of their leases. So long-term, financially stable tenants in prime locations provide a more reliable income stream. So how reliable is the income stream? You take into consideration. The next item is occupancy rate. A high occupancy rate indicates a healthy demand for the firm's properties. So a declining occupancy rate can signal trouble in attracting tenants or higher vacancy costs. So you cross-check a portion of the property that is unoccupied, that continue to remain unoccupied. How is the occupancy rate? Please like this video and subscribe to this channel if you've not done that. Number 4 is evaluate growth potential. You evaluate growth potential. In this case, we talk about acquisition and development plans. Look at the REIT's plan for expanding its portfolio. REITs that actively acquire or develop properties may offer higher growth potentials. Do they have ongoing projects, and how expansive are those projects? You also consider capital expenditure. You assess how much of the REITs expends on upgrading or maintaining its properties. A REIT that invests in capital improvements is likely to enhance the long-term value of its assets. So it's a very important matrix one should take into consideration and evaluate the potential growth of these REITs. Number 5 is review market condition. Review market condition. In this case, you consider interest rates. All right. So REITs are sensitive to interest rate change, as higher rates can increase borrowing costs and reduce property value. So pay attention to the macroeconomic environment and interest rate trends. Interest rate actually will really go a long way in determining the borrowing costs of these firms. You also, consider retail or real estate market trend. You look at the market trend in the real estate sector. So look at some trends in the real estate markets, including property price movements, supply and demand, as well as some overall economic growth. These factors can influence rental income and property values. Number six is look at historical performance. You consider historical performance. So in this case, you may look at dividend history as well as total returns. So dividend history here, you review the REIT history of paying and growing dividends. Consistent or growing dividends, over time are a positive sign. Is the dividend growing? Are they consistent in paying a dividend? How consistent are they in their dividend payments? All these factors would indicate that the firm or the company is doing very well. So you also look at total returns. Consider the REITs, total returns, which include both dividends and changes in the share price. A strong total return over time, over the years suggests a solid performance. Have they been, performing very well? Do they have strong total returns over time? That will indicate the overall performance of the company. Number seven is management quality. You consider the leadership, the management team. So research the experience and track records of the REITs management team. A skilled, experienced management team is crucial to executing growth strategies and managing risk effectively. Then lastly, number eight is compare with peers. So you compare, the real estate investment trust performance with similar companies in the same sector. Are they doing well? Are they performing at an above average rates? You consider their performance in line with other companies in the same sector to see how the company is faring.